Okay, class, today we're going to go over the On Your Own problems for Chapter 9. If you were in class, you saw the work together problems done and should have those completed. If you are absent or you're learning from home, then you'll need to do those work together problems. And we'll do the On Your Own problems today on the recording. So, for Chapter 9, they provide you with a worksheet. The worksheet has all the information you need to complete adjusting and closing entries for this fiscal period, as well as completing a post-closing trial balance, which is what Chapter 9 encompasses. So the first thing we're going to do is complete the journal entries. The journal entries we have to record are adjusting entries and closing entries. So I'm going to put adjusting entries, and the date is December 31st, end of the fiscal period, and the first adjusting entry will be to supplies expense, that is the debit, and the credit is to supplies. I'm going to indent a little bit. And if you look, your supplies adjustment is for $98. So again, supplies expense would be debited and the asset would be credited. And the reason we would do an adjustment for supplies is because we used up some supplies during the month of December. So we have to make that adjustment. Next adjusting entry is for prepaid insurance, because of course we bought our insurance at the beginning of the year, and as each month goes by we use up a little bit more of our insurance. So the value of our insurance will be decreased, and the amount of that is $125. So we would debit insurance expense $125, and we would credit our prepaid insurance by $125 to decrease the value of it. So those are just simply moving the adjusting entries from the worksheet into the actual journal. From the journal, of course, then you would post them into the ledger so you would have the right amount. Now we're going to do 4 closing entries. Closing entries are entries that are done at the end of a fiscal period, or in this case, the end of a month, to close out all of our temporary accounts. Temporary accounts are the accounts that we use on a monthly basis to record our sales, to record our expenses, to record our drawing and our net income or net loss. The first account we're going to close out is sales. Now, as you know, sales has a normal credit balance. When we sell something, we credit sales. So to close it out, we would need to debit it to get it down to 0. The reason we want to add 0 is so when we start the new month, we can start with a 0 balance. So our sales would be debited for $4,160, and our income summary would be credited for $4,160. Income summary is an account that we use only during closing entries. So that is a temporary account, and it's really temporary because literally we only use it for just these transactions. So now we've closed out our sales account, so we've got 1 of 4 done. The next account we want to close out are all of our expense accounts. Now our expense accounts have a normal debit balance. So to close them out, we have to credit them. And again, we're going to use this income summary account to close out our expenses. And I'm going to go over to my worksheet because there's a few. And I'm going to click and drag to highlight and paste. Come back here and I'm going to paste these accounts. So I'm copy and paste. Now, I can also go back and copy the values. So I'm going to copy from this column over here that has all of them in it. And I'm going to Control C, and I learned to post amounts. You have to, instead of just paste, you go to paste values when you want to paste numbers. Now I can auto sum and add these numbers together. And there is my total expenses are going to go debited into income summary, and I'm going to credit each of the expense accounts. So now I've closed out my sales and I've closed out my expenses. Next thing I want to do is close out my income, my net profit for the period. So I'm going to use that income summary again, and I'm going to credit my capital account. And the girl's name is Lana Arola, and it will be her capital account, because when you have a net profit for the period, your overall net worth is increased. In this case, it's $2,732 is going to be credited into her capital account. So her overall net worth was increased, because increases to capital increase your net worth. And the last account I am going to close out is the drawing account. Now the drawing account has a normal debit balance. So to close that out, I have to credit it. And the debit to that transaction goes to your capital, because unfortunately, when you're withdrawing money from your business, it is not good for your overall net worth. So she withdrew $1,700 throughout the month. So I'm going to debit her capital for $1,700, and I'm going to credit her drawing for $1,700, and that'll close it out. So those 4 transactions, to sales, to expenses, to the net profit, and the drawing account, are now all closed out. And that's how you're going to do it for the remainder of the chapter and on the test. Then you have to do one more thing. You have to fill out a post-closing trial balance. And the name of her business is Craigen's Copies. This is a post-closing trial balance, and it is dated December 31st, 2020. Now, on the post-closing trial balance, we are going to list just the permanent accounts. The permanent accounts are the accounts that are left after you've closed. So if you look on here, it goes from cash to capital. All these other accounts we closed out. So I'm going to copy these over to the post-closing trial balance. And I'm going to copy the numbers over, the values. And the values are right here for me. The only value that is changed is the capital. We're going to talk about how to do that. Remember, when you paste values. Now, the capital account is, I'm going to type down here so you can see. So our capital account was $7,443. But remember, we get to add in her income for the period, which was, what was her net income for the period? $2,732. So we get to add in her net income of $2,732, but then we have to deduct the drawing of $1,700. So our actual math, we can do a calculation here, would be 7,443 plus the 2,732, subtracting the 1,700. So her new capital amount would actually be $8,475. I'm going to delete all of that so we don't have to look at it in the post-closing trial balance. Now I'm going to do my totals for my columns of all my debits, and we know debits and credits must always be equal. So I'm going to add those up, then I'm going to add those up, and ta-da, I am in balance. So, adjusting and closing entries, post-closing trial balance, that, my friends, is Chapter 9.